90% of beginner traders lose money in options because they treat it like a lottery ticket. But 10% have it figured out. They treat it like a math problem they've already solved. If you've ever been confused by options, by what a put is, by what a buying a put or selling a put or buying a call or selling a call, what that means, we're going to break it down for you today. So we're going to walk through some basic things, but really options are derivatives. They give you the right or obligation, depending on which side you're on, to buy or sell an asset. Some other things that you need to think about when you look at an option setup, and this is in phase, this is Robinhood, all your other brokerages will look very similar. On the left-hand side, you see the strike price. That's the price that I'm looking to target. So that you see in the middle there, share price, 43.27 for in phase. The day I recorded this, that's what it was at. On the left hand is where I'm targeting to target, whether it's 45, 50, 55, and these are all over the place. On the right-hand side is the premium. So $45 left-hand strike price. The premium on the far right is $11.20 per share. When you do options, you have to do 100 share options. So this would actually cost me $1,120, not $11.20. You look through this and you kind of see how everything adds up. If you take the strike price plus the premium, you see my break even was 55. Going back out just a week, you see the prices are much different. So 45 at the top here is only $90 or 90 cents to get that. So you can see the 90 cents shorter duration versus the longer duration of that almost year out. And we'll get a little more into those. In general, calls tend to be a little more on the optimistic side of the market. You think things are going to take off and be flourishing. Puts, on the other hand, tend to be a little more bearish. We'll talk through these. Buying and selling call options. The first one we're going to talk about is buying the call option. So I have the right, not the obligation, to buy the stock. And what I mean by that is if the stock is trading at $85 and the strike price was 95, if the stock continues to trade for 86 or 87 and doesn't hit the 95, why would I buy the stock? So that contract is going to expire worthless because I can buy it cheaper on today's market. The only thing really at risk here is that premium. So whatever that strike price is, I put the premium out there. That premium is all I really have to be worried about losing through this investment. If the stock runs up well past the strike price of $100 or whatever I put, if it goes to $200, my option is going to be worth a ton of money. Real life example, in phase, I would probably honestly do a little further out if I was doing a call, but sometimes people play these around earnings. But if you look at in phase, it's 43.27 today. I can hit a $43 call, which is already in the money, at a $1.76 premium, or 43.50 at a $1.57 premium. You see the break evens there, 44.92 and 44.60. If this thing runs to $45, $46, I'm going to make some real money in the week. And I would only do a short call if it's something really volatile like earnings or a high volatile stock. But let's talk about what happens when you sell a call. And notice I have the word collateral here. It's important to me that you have collateral on this option. If you don't, you're going in with no stocks. So you could theoretically have to almost buy those stocks in order to sell those stocks. It's not a good mix. That's how people get caught and get in trouble. And by collateral, I mean you have 100 shares of that stock in order to execute one option. With a covered call or to sell the call, you actually have the obligation to sell that stock if it hits the strike price. So if it's trading for $95 today and it goes to 100, you have to sell it at $100. If it goes to 105, you still sold it at 100. So that's where the unlimited risk, quote unquote, comes. But you actually pick the price. So if you already kind of have that baked in, did you really lose money? If you think about it, it's really kind of like a limit order anyway. Not financial advice, do your own research, but this is the type of trade that I typically make frequently. If we look at in phase and it's $43.27, let's say I have a couple hundred shares of that. I'm going to look out a week and I'm going to see that $46 strike price. I see that it's paying a 42-cent premium, which is $42 per hundred. If I have a couple hundred of that, that's $84 that I would get just instantly. Now, if the shares go to $46 or $47, I have to sell them, but I've taken that $42 profit, or $84 in this case if I had 200, and I turn around and I actually just buy more in phase. I do this a lot, and if my shares get taken away, I just turn around and I do a put. It's kind of the will strategy. I'll talk about a will strategy another time. So again, when I buy the call, it's pretty low risk. I have that loss of premium that I could have, but if the stock trades above that premium and keeps going, I have all that reward. If I sell a call, I'm not going to sell the call for less than I have as my average price. I'm going to sell it probably almost like a limit sell anyway. So why not collect that premium? And if I get called away, okay, so be it. As you start doing more and more options, you'll see that most options expire worthless, which means you collected a premium and kept your stocks. Nothing happened, no change of hands. Let's talk about buying and selling puts. These are much different. I know it's hard to follow sometimes with buy, sell, puts, calls, but in this case, when I buy a put, I have the right, not the obligation, to sell the stock. And I would commonly use this to protect my assets. Let's say I'm trading a stock and the stock trades at $100 and I put a put out there, I buy a put for $85. If the stock goes to $70, I can still sell it at that 85. So I didn't lose all the way down to 70. The only thing I'm out here is that premium. If the stock price starts to fall, there's a little bit of coverage here and it's like almost a soft landing for me. Or again, almost like a limit trade. Looking at in phase, the stock trading at 43.27. Maybe I want to look and protect myself from that downside. 1 week, maybe we're going into earnings, or maybe there's some kind of tariff news or something like that. I want to make sure I'm covered. So if I look at $42 strike price, 78 cents premium on the right hand side is what it's going to cost me. So $78 to protect my investment, because remember, it's 78 cents times 100. There's 100 shares we're protecting here. Again, you probably want to look at these a little longer out than a week. I'm just showing the example here so that I'm just kind of consistent through this approach. And you probably want to make sure that you're doing it during those periods of volatility with maybe some bad news coming out, or maybe there's just so much happening with volatility in the market that you just want to hedge your bet here and make sure you don't have a loss. So when you sell a put, notice I have collateral up there again. Usually this is cash. You have the obligation to buy when it hits the strike price. So if the stock's trading at $100 right now and the strike price is 85, if the strike price goes to $85, you have to buy it. If it goes to $80, you bought it at 85. If it goes to zero, you bought it at 85. So there's risk there, but you kind of look at the stocks that you're buying here, and if you're smart about it, you can pick up some good ones. This is a really good way to get back into stocks that maybe got called away, or maybe you just want to get into a stock and you want to buy 100 shares of it at a lower price. So like, let's look back at Enphase, 43.27. If I look down at the $42 strike price, that's actually one that you see that I have. I have this actual option playing out. I get a premium of 72 cents or $72 for that one contract, but I put $4,200 out there because if it sells at $42, I have to pay $4,200 for that stock. So looking at these two side by side, the put buyer has limited risk because they paid a premium and they're hedging their bets. The put seller has steady income, or maybe they're trying to get 100 shares of a stock back in at a lower price. If they play it out far enough, and a lot of people play this game, they can make a lot of good money putting that out there that they're going to buy those stocks if it keeps falling down and the market keeps going up. The option expires worthless and the money's there. Just some things for you to keep in mind with each option. What is the volatility of the market? How long do you want the trade to be? What is the market outlook? Is it bullish, bearish? What's going on? What is your objective? Income, get into a lower deal, buy stocks cheaper? What do you want to do? What's your risk? Hopefully that explains a little bit for you guys. Make sure you check out some of my other videos. About 80% of you haven't hit that bell yet. If you could please hit that bell, like and subscribe, comment down below. It means the world to me. Thank you. Stick around. We're going to do great things.